Mutual funds, index funds and ETFs. What are the main differences and which is the most suitable for you? The similarity between all of these funds is that whatever that they are invested in is determined by a portfolio manager. Now those assets can include stocks, bonds and commodities. Now what are the differences? Firstly, it is how and where it is traded. So let's take a look at this chart over here. So exchange traded funds, they are traded on stock exchanges. Okay, for example, the Singapore Exchange, SGX Exchange. Okay, whereas for index funds and mutual funds, they are not traded on exchanges and they can be bought in financial institutions or online platforms. Okay, financial institutions can include like banks and insurance companies. So financial institutions and online. Same with this. Another difference is that exchange traded fund can be bought and sold at any time when the market opens, just like a stock. Whereas for index funds and mutual funds, they can only be bought and sold after the day has ended. Because once the day has ended, then the price, which is called the net asset value, will be calculated so that investors can use that price to buy and sell the funds. The second difference is the strategy. Now for exchange traded fund and index fund, what they do is they track an index. They try and mimic the performances of the asset classes in the index. For example, the Straits Times Index, which is the top 30 Singapore stocks, blue chip stocks. Okay, so these funds are trying to mimic the performance of that index because no one can invest in the index. Whereas for mutual funds, what they do is they try and buy and sell units or the different stocks so that they can try and beat the index. Okay, like the Straits Times Index. For example, if the Straits Times Index is performing at 6% every single year, the ETF and the index fund aims to perform at 6% as well. Whereas for the mutual fund, they aim to beat the index, which is performing more than 6%. The last difference is cost. For exchange traded funds and index funds, they usually have lower cost compared to mutual funds because exchange traded funds and index funds, they are considered passively managed. However, if you are using the dollar cost averaging strategy, which is investing in regular periods of time, an ETF will incur a lot more transaction costs. Okay, so transaction costs for an ETF is a lot higher, but in terms of management fees, ETF and index funds is a lot lower as compared to mutual funds. Because mutual funds, you have to pay for the transaction cost that goes in within the portfolio, as well as you need to pay the analyst for monitoring and researching and analyzing your assets in that portfolio. So which is better? Now it depends on your preference. If you're looking to save on your fees and matching the performance of your market, then perhaps the exchange traded fund or index fund will be more suitable for you. However, if you don't mind paying higher fees for potential higher returns and possibly beating the market performance, as well as the flexibility of you choosing which sector you can invest in, which asset classes you can invest in, perhaps a mutual fund will be best suited for you. Now, if you want to know which is the most suitable for you, you can look for your trusted financial advisor, or you can DM me. I'll put a link below, okay, where you can DM me and to ask me, which is more suitable for you.